William says, I was fortunate enough to sell some of my positions into strength over the past 3 weeks. As a result, I was holding some cash in my trading account at the beginning of this week. There we go. Can you show me how to use power options to determine the best process to analyze whether to sell SPY puts, buy VIX calls, uvxy, or anything else you might suggest for playing increased volatility in the process to analyze different strikes and expiry dates? Okay. Now, first thing I'm going to say here, William, is I don't like the idea. Thank you. Thank you, William. I knew that's what you meant, and I was going to ask you to clarify. He meant buy SPY puts, not sell. He's talking about market hedge in that case. And so what he's looking for in the market hedge, a broad market hedge, is we have different things available to us as options investors. If I have core stock holdings in my account, I can insure those core stocks with a married put position. That's what I prefer to do. But I've got portions of my portfolio in bull put spreads, portions in leveraged spreads trades. Sam has portions of his portfolio, as he mentioned, in bull put spreads and other leveraged positions. Many of you probably do as well, even if you're buying calls, speculating on the market movement in those cases. So one idea is to buy puts on a broad-based index or ETF to ensure those portions of your portfolio, if you're not using married puts, if you have a larger sized leverage portion of your portfolio, meaning you're buying calls for speculation, calendar spreads, bull put credits, and more. And we call this, of course, stock or portfolio insurance. Sam also brings up another point I'll get to as well. You sort of mentioned that, William. I think you said uvxy. Okay, and anything else I might suggest? That's where Sam's going with this, okay? So I'll get to that in just a moment. So naturally, of course, when I talk about the different market hedges we might use, it's buying puts again in a broad-based index or ETF. And I prefer the ETF, SPY, QQQ, maybe even IWM. What is the decision process, number one, for deciding to buy on SPX, QQQ, or IWM? That's based on where the majority of my leveraged trades are. So if I'm using portfolio insurance to insure the current bull put credit spreads, calendar call spreads, or other positions I have, I look at my portfolio and I see 70% of those positions, 65-70% of those positions are S&P 500 stocks. I'm buying puts on SPY or SPX. I mentioned I prefer SPY. No gauge that it's better. I just like the lower cost at first. But yes, to hedge the portfolio, I may have to buy more contracts at the 1/10 price. You understand what I mean. If I'm heavier in tech, I might buy puts on QQQ or NDX. And of course, if I just notice that many of my positions are linked directly to the Russell 2000, then I'd be buying on IWM and things along those lines. That's a great point, Sam. I'll get to that in a moment. I had forgotten about that one. That's a newer one I had forgotten about. Okay, so in any case, in older days when volatility was low, 11 or 12, yes, there were times less than 3 years ago, maybe 4 years ago, but 3 years ago or so in 2018, volatility index was at 9, 10, 11, not 33, not 28, not 45. All right, volatility index was lower. And a good approach for those events was buying a VIX call that was essentially 45 days out in time. And in general, I'll look for the same thing on the SPY puts, but with one other subtle caveat here. Typically, what I would look for with a VIX call, William, is I want to go out maybe 30, maybe 45 days out in time. And let's just look at calls real quick here. So we're just on the option chain. And I'm going to have to go to a larger chain here, aren't I? Yes, I am. All right, so we're meeting. I got to go to the large chain. That's no problem. So even 32 days out would be fine, but out to March gives me some more time on this position. And this is what I don't like here. Okay, it's hard to explain what I typically look for is a delta of 0.3 to 0.29. This is my delta category here, okay, my delta column. And around 0.3 is what Ernie and I usually target for these protections. And the price is, 275. That's not too bad. 245. And we're roughly 50% out of the money. 45, 50% out of the money. This is what I said I don't like. When the VIX was around 10 or 11, I'd be buying 13 strike calls on the VIX 35, 40 days at a time for $1 per contract. I'd be buying, when it was at 14, maybe 13, I'd be buying 16 strike calls for about $1. And that's a deep amount of the money, right? So, I'm talking about 20% in the money or so, 2 points on $10, 2 points on 11, I'm talking 20, 25% in the money for $1 premium. Not 45 to 50% in the money for almost a $3 premium. Right there, that's where I don't like it. Is it possible that if that sudden unexpected event happens, we could see the VIX shoot up to 60? Maybe, but it would have to be severe. Okay. This is why I've backed off the VIX personally. You've heard me talk about that, and why I started at one time buying shares of uvxy. What's the difference? uvxy is just a volatility ETF. I had traded VXX before as well. In that case, VXX was one I had used. They changed it around a little bit, became VXXB. Sam had mentioned to me, because it's also an ultra. So when it takes off, it really takes off. But when it's just subtle movements, it's not that big. So how has uvxy reacted? Let's go back 6 months on this one. How has it reacted to some of the market turmoil? Well, you can see we get these little pops here from 20 to 32 almost. It settles down there. We get down the lower range about 16 to 22. Okay, so there are moves there, but this is only being used with a very small portion of the portfolio to hedge your portfolio by half of what you expect at the loss. Sam says he's in uvxy at 11 right now. That's excellent. Remember, Sam, when I was having losses on uvxy because my other spreads were doing well, I told you I was keeping some small shares of it and averaging down. I am now at a really reasonable cost basis similar to you. I think I'm down at 1250 right now with the shares I have in uvxy to protect against a big move. And that's worked out pretty well these last 5 days with things going on. Okay? But what you have to do here, you could hear me say it, William, and I'm just talking about what I've kind of done in my portfolio decision-making process. But we're going to give you a list of some things here, okay, with Sam's help as well. Let's just stay here and, take a look at these dates here. I'm sorry, this is a September, beginning of September, and right into the election there. End of October, beginning there, where the volatility spiked. So right at the beginning of September, when the market started to turn, and then November, right before the election. Okay, and so let's see how SPY reacted, because remember, in this case here, at the beginning of September, that decline did take off, so uvxy would have helped, so would have VIX calls if they weren't too expensive. That's one of the problems with buying puts or buying calls on the VIX. Is that in this case, when the market's going up here, after the first fall starts to trigger, so you want to get in over here. When the sell warning started to appear, the bearish sell warning started to appear on the market sentiment tool. That's when we consider these movements. You and I talked about that at the end of August. It was August 25th, I believe, when those triggers started to hit. And so that's what SPY did. And then going into the November election, of course, there we go. We saw that dip leading down in this case, and the volatility was moving up because of the unknown events coming forward. Earnings was going on too, and then we had the election, and we were still dealing with the pandemic as well. So in both of these cases, what I'm showing you here, of course, trying to illustrate here, is that puts on SPY would have worked. Shares of uvxy worked in these situations, as you saw those two jumps up. Were calls on the VIX as well? Would they have worked also? They probably would have done some profit, but if they were overpriced because the volatility was still high, higher than normal, 24, I think it was in August. I think it was around 28, perhaps right leading after that September decline, and still fresh in October, but leading up to the November election. That's what we were seeing. Okay, so they are probably relatively expensive, even with that 0.3 delta, where at that point, it's likely that the puts on SPY, let's do that, August 25th. We're going to take a look at that in a moment too, August 25th. And we'll call it, when we looked at it, October 28th, maybe October 26th, somewhere in that time frame. All right. So the concept that we would use, whether I'm buying calls on the VIX or puts, what we typically look for is an out of the money 35 to 40 day out 0.3 delta. That's usually what Ernie and I prefer to use as a hedge. So let's go back to August 25th. Let's pull up the VIX chain again. Let's go back to, one moment, folks. I'm sorry. I'm going to pause the screen. If I forget to unpause the screen, remind me again, please. All right, so there we go. Unpause the screen. You're looking at the same thing, I know, but now we're looking at my actual account instead of the webinar account, where I'm going to go back to August 25th. And we saw right around November 3rd or 4th is when the volatility spiked the highest, but that's okay. And let's go ahead and get the chain from August 25th when we started to see the sell warnings. And it was down to 22. Okay, that's somehow we just picked the bottom. I don't have a 45-day out in the cycle. I don't have a 35-day out. But I wanted to go through. Now we can go here. I'm going to go here, okay? So the September 29th series, this is a comparison. So on August 25th, for the September series, September 23rd series, I'm sorry, 29 days away. What do I want? I want calls only. Here we go. 0.3 delta, that's not too bad. But the price, look at the price. Okay, instead of going 20, I'm sorry, that's not my in the money range. Where is it? Oh, I thought I had it here. Okay, I don't. All right. Anyway, long story short, my range in the money here, we're going 3 points up, 25, 26, where my delta is 0.26. Okay, so let's say we bought the 26 puts, 325. Small portion of my portfolio. And that's the midpoint, right? Yes. Now we go to sort of the end of September. So on August 25th there, we go towards mid-range of September, let's say the 21st. September 26th at 325. And wrong date. It only went up to 228. Okay. So we went from 22. We lost money because of the time. It was overpriced, wasn't it? It was a fair amount of time value. That's why I said it was over 10% of time value for 29 days. That's sort of the warning sign I was mentioning. It's too high of a time premium to buy into. The stock went up from 22, roughly, the security, the ETF, went up from 22 to 27.78. It was even up $1.95 on this day. But because that high price we paid in and the way the volatility futures work, the 26 was only worth 228. But of course, we are only 2 days away from expiration. So I lost money on this hedge. From 325 to 220, I lost $1 on the hedge. Let's go back 5 days, 4 days. In this case, okay, so we know that this one, holding it as close as we could to expiration, didn't work out the way we wanted to. Let's go back to the 16th, right before the expiration. 26 is still worth about 220, with the ETF trading right around 26. The index, I'm sorry, trading right around 26. Now, same idea. Let's go to SPY. And let's go to August 25th. Keep the same time frame or close to it. We'll use September 23rd or September 29th for SPY. We're going to look at puts only this time, right? And of course, I need to change my date. Give me 1 second here. Now, I have a feeling this one's going to be profitable. '28th or 30th. Fair trade. Let's use the 30th. It's like a quarterly option almost. Okay. So the puts now, SPY at 344.12 on August 25th, we started seeing bearish sentiments. Okay. And sorry, there it is. I'm in a different one. Almost there, folks. Sorry. 333 put at 449. 0.3 delta. Now, this is just our preference. You, of course, can go back later, William, and check to see if a 0.5 delta is better. It's going to cost more and you're paying the more time value. That's why Ernie and I like to use the out of the money with a 0.3 delta or so for the hedge when using options, index, ETF, or what have you. Okay. Now, okay, let's call it 450 just to keep the math simple. 449, 450. Let's keep the math simple there as well. And August to September. And we looked at the 16th. Remember at 344.12 on SPY. Looking at the September 30th put options. Cost of 450. Here we go. 338.22. Nearing expiration. Get the right expiration, Mike. I knew that I was going to have to change that. Sorry. So we see our 333 strike on the series at a single digit. So give me a second. There we go. And it's at 392. It is also losing money in this case. Let's go to that next time frame and see if it dropped below it, but I doubt it dropped enough to make it a profit. Now, I'm not saying that these hedges weren't profitable at any time during September. What I'm saying is this is the battle that we've been fighting with these types of, I'm sorry, let me go to like the 11th. The battle that we've been fighting with these approaches is that increase in volatility across the market. The VIX and others have meant that we're paying into higher time premium for roughly the insurance that we want. And if we're not out far enough, the time decay is hurting the position because of the increased volatility. I just went 4 days earlier to the 11th and the 3, there you go. That would have been the perfect time. I'm in the wrong expiration, aren't I? No, that's it. Okay, so on the 11th, as the market was falling, the 333 puts had gone from 450 up to 737. So that's around the time frame we wanted to look for. I should have done that more, but that's okay. That's what we were looking at in that scenario. That's what the hedge would have done. So from 450 up to 737 as a partial hedge. The VIX calls might have done the same on September 11th. We can look at that later. But there are different ways to skin a cat, and that's what we're talking about as well. And some of the other concepts that Sam had mentioned here also. And you can see there was some increase in volatility, but there wasn't a lot. I mean, it moved up to 0.2543, but it was around 0.22, I think, or 2.1 when we first started. So there was some increase in volatility there, and it would have been profitable as a hedge as the market was declining down in these cases. All right, so why did I start using uvxy? I started to use uvxy because the VIX calls were, and in my opinion still are, too expensive as a proper hedge. And remember that the VIX index does not work. Well, it works, but it doesn't perform similar in the sense of an underlying ETF or an underlying security. Meaning what? Meaning that the price of the options and the price of the underlying index are based on the futures index, futures prices for the volatility. It's not one-to-one. I can have a 22 strike call on the VIX and the VIX be at 22. I'm sorry, I can have a 22 call on the VIX and have VIX be at 24. My call option can be worth less than $2 based on the futures prices for the volatility options. Okay, the futures volatility. It can be less than intrinsic. That can get you caught sometimes in those situations. But when they're overpriced like they are now, you saw my 0.3 delta was a 10% price, 10% time value. Essentially, it was 350. It was more than that. when the VIX was at 22. That's too much, even though I have the right delta. There's a fair amount of time value in that 30-day out SPY put as well. It was priced at 450, which is more suitable. We're looking at like a 1% time value. Well, a little bit more than 1% at that time. That's a little bit more to digest. But you saw there at September 11th, it was profitable. But a couple days later, when it started to recover, it didn't look like it ever came back to profitability, which is one of the problems with using options for a hedge as well. When that first snap happens, that first negative movement happens, that's when you want to go ahead and start thinking about closing that hedge, closing half of that hedge and moving on. Now, that's why I started using uvxy, because the VIX was too expensive. The calls in the VIX were too expensive. Sam helps me out here with some points, some good points here. Here's some other ones for you to jot down, William, and we'll record some of them here as well. Sam is using inverse ETFs, the ultra short SQQQ. SH is the single short, just the inverse of SPY 1-to-1. Here's one of the ultra ones, and SRTY. These aren't related to SB, but SRTY and FRZ. He only saw about a 5 to 8% gains in those this week. SPXU is another one to consider. So you have SQQ, SH is the single, SPXS. These are against, so those are against SQQ is against QQQ. There's also TQQQ is the other one. SH is the single short. SPX, I'm sorry, is the 3 times bearish ETF in that case. So buying shares of this, if SPY falls, this moves up. There you go. Not up a lot, 5%, like Sam mentioned. But now you don't have to worry about the time value. Now you don't have to worry about the expensive cost. And this is the one I forgot about that I'd mentioned when Sam posted it. If you find yourself heavy in FANG stocks, William, or anyone online or anyone watching this recording, there is the inverse FANG ETF, FNGD. Not optionable. But you can buy 10 shares, 20 shares, 30 shares or so to act as a hedge if you're heavy into the FANG stocks in case of the unexpected. So those are some ideas on how I approach that, William. Those are some of the decision-making processes I use. Why I have been saying since February, since before February actually, I haven't been using VIX calls because of the price, but I was using uvxy. But there are other alternatives out there that Sam had mentioned that I look into from time to time as well. The SQQQ, SPXS, and this one here is a good one for anyone in the FANG stocks, FNGD, sort of the -3 times inversed leveraged ETN. It's actually exchange traded note, not directly an ETF. While we're looking to see if any other question comes in, I just want to remind everyone, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance, and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or direct trading suggestions. Options, and in some cases stocks, are taking the wrong play, involve risk, as we saw multiple times this week, may not be suitable for all investors. If you liked what you saw today of some of the portfolio tools, we showed those rollout opportunities for Bill. And we looked at some rollout opportunities for Ha as well. We looked at the market sentiment tool and some other search tools and the historical tools with the chain. Remember, you can get full access to these tools at any time for 14 days, no credit card required. Just go to powerup.com, enter your name and email address, and you'll have full access. We'll send you a password, and you'll have full access to the site for 14 days. The search tools for the 23 different strategies, research and analysis tools, portfolio tools for tracking, and much, much more as well. Now, after the trial period, the subscriptions start at only $45 per month for the end-of-day data service. The delayed service, just about only 12 to 15 minutes delayed, is only $65 per month. An upgrade to the delayed service, just $35 more, to have everything on delayed, but full access to the historical suite of tools to go back and look at historical prices, whether on the chain, or run historical searches using the search tool to find positions that match your criteria and see how they performed over time. And then, of course, we do offer a real-time service as well. We saw some of the free education. We mentioned the webinars page and the blog. You can access the webinars page at powerop.com/webinars.asp. And of course, you go to our YouTube channel, as I showed, and just do a basic search for the type of strategies and criteria that you are looking for as well in that case. And any other questions, of course, you think of later on, send us an email at any time to support@powerop.com, support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. Remember, trial members and subscribers can schedule a coaching session at any time.